From on this story, we're joined by Nadia El-Bilasi in Dubai. She's an equity group senior market analyst. Nadia, thank you so much for your time. So, as you just mentioned, oil prices are pulling back after the Israel-Lebanon ceasefire announcement. I know we have this conversation in the media sphere every week, 2 weeks since this conflict began, but do markets believe this is the start of a broader de-escalation in the region, or are traders still pricing in significant geopolitical risk?
Good morning. Yeah, so markets are weighing two things right now, which is the geopolitical risk. I don't think that this is going to end very soon. So they are still pricing whether actually the negotiations are going to come to an end or not. Oil prices have eased slightly, but I do believe that we have a bigger issue with supplies. And we already saw that the ADP oil supply has decreased by 8 million barrels. So I think this it's still weighing on the relatively the trend in the stock market. So I do believe that just the ease off is headline news, and I think that the more good news that we get on negotiations coming up with or ending soon, this may drop oil prices instantly. However, I think we're going to remain in the mid-90s so long as we have these tensions still going on in the market.
Yeah, indeed. That's how it usually goes, doesn't it? But we're also seeing stocks fall even as oil prices ease. What does that tell you about investor sentiment and concerns beyond the Gulf conflict?
I think that investor sentiment also eased off. We are waiting for the non-farm payrolls this week. I think the labor market's proven that it's still healthy, but somehow good news have become bad news because it's going to push back on rate cuts. And I think that's what market really need right now, because over the past 2 years, rate cuts have really been basically supporting the equity market very much so, and especially the rally is, of course, hand in hand with the AI trade. So I believe that the more that we push back on rate cuts and even maybe face a rate hike due to higher inflation prices, due to higher oil prices in the energy markets and lower supplies, which is very much worrisome. But I think the overall picture here is weighing on investor sentiment, so long that we have a resolution, whether just the setbacks of the oil disruptions have already weighed on the market, of course, hand in hand with the fact that we might see a rate hike, which will weigh on corporate margins and corporate taxes as well. So it could dim the sentiment for the tech sector as well.
And as we mentioned earlier, Asian stocks are mostly lower. There's less enthusiasm today around the AI trade. Do you see this as a temporary setback for AI, or are we starting to see signs of fatigue in the sector?
I think we've had incredible earnings. Maybe Broadcom just missed revenue expectations, which have dimmed sentiment a little bit. But in general, we are still seeing spending, a lot of spending into the AI infrastructure. And I think that's bound to continue. I think just investors are being more in those corporations that have proven to have great revenue streams and marvelous earnings as well. So I think it's just a matter of a cyclical rotation, and I think that the more that we're going to see more AI spending. I think by 2027 it's going to reach even 1 trillion in AI spending, but we are seeing great earnings and forward guidance. So I don't think so. Yeah, I do believe that this is just a temporary setback due to geopolitical risk going on.
Okay, Nadia, it's great chatting with you. Thanks again for your time.